It has been an extremely volatile week for the market, with massive swings up and down, from coronavirus fears to Joe Biden winning a lot of states on Super Tuesday that bumped the market right back up, to coming down again, with bonds going up and down and treasury yields. It's been a mess. And this is all sparking talks again of yet another recession coming. Now, if you haven't seen my video yet where I talked about the coronavirus and how it might affect the economy and investors, I'll link that video down below. You could see it, but of course watch this video before going to that one. So with the virus spreading across the US now, with more than a dozen deaths at the time that this is being filmed, it's as if impeachment and the potential trade war and the Iran war, all of this, it's as if it never happened. And the reason why there's so much talk of this causing the next recession is that it doesn't look like it's going to be contained anytime soon. A vaccine won't be available for another year to a year and a half, and the Federal Reserve recently cut interest rates as an emergency measure. And this also could very well hurt Trump's re-election, because he's running strongly on the economy and the stock market, and if this runs through November, the chances might be a little more slim than they were before. So in this video, I'm going to be kind of giving an update on that last one and why the Federal Reserve chose to cut interest rates, if we can expect this to last a long time, will the volatile market ever seem to slow down. We're going to be going into depth all in this video. So this past Tuesday, the Federal Reserve, as an emergency, cut interest rates by 0.5 percentage point, and this is the first time they're doing it since the 2008 financial recession. It's a bold attempt to give the US markets and economy a jolt in the face of this growing outbreak of the coronavirus. This is also the biggest interest rate since that 2008 recession, and now the benchmark interest rate is somewhere between 1 and 1.25%. Now, although the fundamentals of the US economy remain strong, the central bank said in a statement recently that the coronavirus possesses evolving risks to the economic activity of the US. And the chairman of the Federal Reserve, Jerome Powell, echoed this sentiment in his subsequent press conference on Tuesday. He said, "We saw the risk to the outlook of the economy and we chose to act." He said the financial markets are functioning normally and the economy is going just fine. He said he 100% fully expects the United States to recover after this outbreak finally ends. Now, the emergency rate cut did come as sort of a surprise, even though the market did soar, because it was expected that there was a 100% chance of another rate cut coming in March. That was on Monday, and the whiplash signaled that America may be in a bit more jeopardy than previously thought as the markets tumbled on Tuesday. Powell admitted that no one really knows how long this could last, being that we don't know when this outbreak will truly end. He added he knows the US economy is strong and will get to the other side of this and return to solid growth and a solid labor market as well. He admitted although a rate cut won't cure infections or fix a broken supply chain, it will boost household confidence as well as business confidence as well. And the potential damage to the US economy is still an unknown. Powell said any coronavirus-related slowdown is still in an early stage. We truly don't know, although many industries such as travel and leisure are reporting great losses to their businesses. Now, the central bank did not discuss any other forms of stimulus to this economy, but the market is expecting the Fed to continue to slash rates in response to this virus. The market is expecting a 60% chance of a quarter-point rate cut during the Fed's meeting in April. Economists are mostly worried about the effect the outbreak will have on global supply chains and trade and consumer spending. Consumer spending is really the backbone of the US economy. Now, the OECD, or the Organization for Economic Cooperation and Development, warned that global growth can potentially be cut in half if the outbreak continues to spread. And the biggest companies in the world, such as Microsoft and Apple, have issued sales and profit warnings. This is because of travel restrictions, factory closures, and supply chain issues. Now, Powell did note that it is up to individual banks on whether or not they want to act as well as the United States just did. He hinted further rate cuts from international banks could be on the way. The Reserve Bank of Australia slashed rates by a quarter point on Tuesday. Now, Trump has been a long advocate of lower rates, and he did cheer the recent rate cut by the Fed, but insisted that they have to do more and actually potentially cut it to zero. This quest to avoid a coronavirus-fueled recession may just be getting started. Remember, the Fed has used this before, such as September 11th, the collapse of the Lehman Brothers, the burst of the dot-com bubble. This has been done before. And more alarmingly, the 10-year Treasury yield plummeted below 1% for the first time on record. These are definitely signs that the Fed will have to further cut interest rates and potentially even plunge them back to 0%. This is emergency territory that was last experienced during the aftermath of the Great Recession, but it might be 100% necessary. Now, David Kelly, the chief global strategist at JP Morgan Funds, said he would not be surprised to see if the Fed went back all the way to zero. And the bank's U.S. economic research team told clients that they expect a 50% chance, that's 50% chance that they will see rate cuts go to zero this year. Now, just the thought of returning to rock bottom rates was inconceivable, unthinkable just a few weeks ago when the American economy is running full steam ahead. And remember, this is just the latest stress that the Fed is rushing to ease. Last year, when they were seeking to blunt damage from the US-China trade war, they cut interest rates 3 meetings in a row. And after delivering those rate cuts, most Fed watchers were expecting the central bank to sit on its hands for a while. Recession fears eased, hiring rebounded, and the trade war cooled off. And on top of that, remember, US stocks returned to record highs all time. But Dutch bank Rabobank warned that the Fed was not nearly done back in 2019. They warned that the Fed would have to cut interest rates to zero to fight off a potential recession. There was a lot of pushback from that warning, but now with the mayhem in the stock market and the volatility, and now with the coronavirus outbreak, people aren't looking at them so silly anymore. Now they're saying that they would have to cut interest rates to zero faster than they expected. Now others do say it's premature to predict a return to zero interest rates. After all, if the coronavirus does less damage to the US economy than feared, stocks could rebound quickly. And even if the economic pain does prove significantly, there's a chance that cutting them even lower than the low levels that they already are at won't really do much to help the problem. In financial circles, that risk is known as central bank impotence. Analysts are saying that there's a diminishing effectiveness of cutting interest rates. The bank may not want to create even more panic in the markets, although it seems to have already done so. But one thing is for sure, the bond market is signaling that the Fed does have to take further action. The 10-year Treasury yield plunging below 1% set off alarm bells all over Wall Street. Now, JP Morgan does expect that the US will avoid a recession in 2020. But analysts are saying that as it is right now, there is a chance of a run-of-the-mill recession, a 90% chance that is, compared to a severe one like the 2008 Great Recession. Now, this also raises speculation that potentially the Fed will follow in the footsteps of Europe and Japan and actually offer negative interest rates. President Trump has also been a strong proponent of the Fed to make the interest rates negative. But such an extreme drastic step would slam savers, banks, and insurance companies. And there's little to suggest that sub-zero rates have worked. Europe and Japan are still in sluggish growth with little to no inflation. But the Fed is being vigilant and studying tools that they could potentially use in a downturn. The Fed will be open-minded when it comes to the pros and cons of negative rates. More likely, the Fed will probably turn to the more extraordinary measures it took during the Great Recession. This includes the Fed promising to hold rates low for a long period of time, otherwise known as forward guidance. But the Fed could be forced to relaunch quantitative easing. In layman's term, this is a crisis-era bond buying program. It's aimed at keeping borrowing rates low and stimulating risk-taking. Now, some investors do argue that potentially the Fed has already taken a step to a stealth version of quantitative easing. But it is no secret that the central bank can't solve the coronavirus outbreak scenario alone. There are growing calls for Congress to take action and step up to avoid a recession and prevent it. Trump has already urged Democrats in the House to think about potentially having a one-year payroll tax cut. Other analysts are saying the government should create a special lending facility. This is in order to provide financing directly to small and medium-sized businesses. The goal would be to minimize bankruptcies and layoffs. One analyst said that we're going to have to rely on the big guns, the fiscal bazooka. So let's make some predictions. Do you think this downturn could potentially last a long time? Let's predict when it will end. Tell me down in the comments below. Do you think the Fed will decide to cut interest rates to zero? Let's all make our predictions down below and check them a little bit later. Again, as Buffett has said, we have gone through every single war and depression and every single event that thought the US would be finished. So I think you should just use a buy and hold strategy, continue to buy as you're regularly scheduled, potentially buy a little bit more if the market is down. That's what I did. One of the following recent days that the market dropped, I scooped up some stocks. But with that being said, I do hope you enjoyed that video. If you got value out of it, be sure to give it a big thumbs up, smash that like button. And if you'd like to see more videos from my channel, I post videos every single week covering business, finance, entrepreneurship, mindset, strategy, and tips and tricks. I'll be sure to update you if anything happens with this coronavirus. You don't want to miss any videos. I post videos every single week without fail. And if you'd like to be notified so that you're first in line to see that next video before anyone else, be sure that you hit that little notification bell as well. Looking forward to seeing you in the next video.